All right. Welcome, everybody, to another Pepperstone Learn It Live event here on YouTube. Today, we're talking about another one of our pretty much favorite topics, which is, of course, to discuss news, day trading, and scalping around that news. We'll be understanding quite a few things today, but I think Tyron and I are both excited to show you one of the strategies that we've really worked on a lot over the years. And this has got to do with something that's more replicatable on the daily, especially for currencies and even for stock market indices as well. So I hope everyone's having a great day. My name's Thomas Atkinson. And as always, I'm joined by Tyrone. How you going, Tyrone?
Good, thank you, Tom, and welcome everybody. I tell you what, I'm not sure where you're all from. I'm sure you're scattered around the world, but it is getting cold in Melbourne now. Like we are certainly getting the winter woolies out. But we're gonna bring you a fun-filled webinar tonight and hopefully give you some enlightened information about tonight's topic. It is one that is close to our heart. We probably say that every time we do it, but you know, everything that we do in trading is close to our heart. So
that's because I turn everything into Wyckoff.
Yeah, and at some point throughout the webinar, I am certain we will see Wyckoff turn up. So
don't you worry, he's coming. So yeah, that's right, Ty. All right, well, we'll get into it. Just before we go any further, obviously a quick disclaimer. Make sure you take a look. Here you go. All right, we'll get into the beginning. So as we start today, we'll go through a little bit of theory, then we'll place some of this theory into practical application, and then we'll go from there. So what are we doing? We're trading the news. We're listening to the idea of strategies for scalping that news. We're going to be learning how to profit potentially from news by understanding the impacts of what actually the market is trying to do around news, and why most of the time your actual interpretation of it is generally going to be wrong. Has anyone in the chat had that way where the market's gone in one direction and then instantaneously about maybe 20 minutes later, half an hour later, it's gone off in the opposite direction? You're left scratching your head saying, but that's not what the fundamentals are telling me. Well, yeah, I'll put my hand up. It's happened to me. I'm sure it has happened to a few people in the chat. If it hasn't happened to you probably haven't been trading long enough.
Yeah, no.
But we'll be talking about why that does happen. And then, of course, we've got Q&A as well. If you have a question throughout the session today, feel free to ask it. We are monitoring the chat. So I'll give a bit of a shout out actually to some of the people that came in very early. We've got Cedric, Roman, Pirate, Zamaro, Trish, Daniel, Diamond, another Diamond, Double Diamond, Diamond Eye, Diamond Dozen, Bill, CME, Ken, David's true, Javid. All right, good to have you here, Shaff, and of course, Royston. I like how there's double diamonds there, Ty, out of nowhere. So we'll be going through learning the profit of the news, gaining insight into how you can potentially, think about it a little bit differently and not get trapped in maybe the bad news moves. And then, of course, we'll be also learning how to more effectively manage our risk by implementing a solid risk management plan. So, yep. Here he is. Here's Wyckoff. But obviously,
in the first 5 minutes, how rude.
I knew he was coming. He's always coming. But the reason we want to put him here on the chart is really just to give ourselves a bit of an understanding. Now, maybe I'll put Druckenmiller on the charts in the future, Ty. If you're not sure who Stanley Druckenmiller is, he's one of the best investors of all time, averaged 30% per annum, et cetera, et cetera. He's actually a trader more than even an investor. But one of the things that all of these guys always say, it's very true also to what's made us successful, is to think a little bit outside the box and often to really understand the psychology of the market. And that is actually part way towards success. Yes, technical analysis lets us see the price action and therefore the psychology. But realistically, we also want to understand the study of force. And it requires our ability to judge which side the power is on. And of course, Druckenmiller had a similar thing. He said, be a pig. That is, think about things a little bit differently than necessarily a standard bull or a standard bear. You've got to think different. Even, Steve Jobs technically said the same thing as well, Ty. That was literally the motto of Apple. It's kind of like the motto of success, isn't it, really? You've got to think a little bit outside the box, but not within, super complex reasoning. Sometimes people go a little bit too wild and trying to, come up with conspiracies. What we're really wanting to do is recognize the reality of the situation. I write patience, Ty. React, don't predict. And I think this is going to be something that is going to be very helpful for anyone that's never heard our work before. And if you have heard our work before, I actually recommend you usually write patience, react, don't predict on your charts. And what that does is it helps you, especially around news, to instead react to the news and wait for the potential trap. Okay. Wait for the market to go off in one direction, then reverse. And if it does a certain thing that's replicatable, that's what we want to be targeting, isn't it, Tyron?
Yeah, most definitely. It's amazing how many people actually start out their trading journey thinking that news is where it's at, and they attempt to pick the direction. They straddle the market on both sides. And look, for those of you who are joining us live, for the ones that are joining us live at the conference in Vegas in September, when we get a few drinks into Thomas, we'll give you some war stories on how we used to trade the news when we first started trading. that is for another day. But look, it's not that you can't trade it, but you have to trade it in a sensible way. It's not as easy as just trying to pick the direction or trying to really decipher what the fundamental outlook is going to be from a result. For instance, like you might see a non-farm number or an interest rate decision and think the market has to go one way or the other. Let's go. It doesn't always work that way, does it, Tom? Like you can learn it the hard way. Absolutely, learn that the hard way.
And generally you do. So if there's one thing I think you get out of today's session straight away, that's a big idea, is potentially be a little bit more patient and react. They often say that the person, the richest people I've ever talked to, Ty, the ones that you know as well, and we know a few people, luckily enough, we know a few people that are basically billionaires. And these guys, they all have very similar characteristics. Yes, they're generally very astute on things, but they're prepared to really wait for the opportunity, aren't they? But when they see it, they go. My goodness, they don't just go a little bit, they go a lot. Now, you might not want to go their way, but they really do react to an opportunity when they see it and when they know it's there. And they'll go harder the more they know, is the way I always see. And that's what Druckenmiller said as well. So, Ty, how do large traders actually enter positions? We've used this chart before, which is basically just some lines, and I'm going to draw it for you all now. So we've got we can apply this to currency, we can apply this to commodities or stocks or indices, doesn't really matter. We're just going to make this simple and basically just put this as 0.0070, 0.71, and 0.72. Now, it's different on each time frame, but basically if a market's coming down, somebody might say, based on history, that this is an area that they're interested in purchasing. They might deem it as being cheap. Now, a big fund cannot enter all of their money at once. So what they do is they push the market around and the market comes down and they start purchasing. This is what they consider premium. This is what they consider fair value. And this is what they'd consider as cheap. As it comes through the fair value into the cheap line, effectively what they're doing is they're purchasing higher and higher quantities. And that's often why down in the bottom, if it's created a range or an accumulation area, you often see wicks. And Tyron and I love wicks because wicks on any type of like time frame or candle can often show excitement in the market or orders. Now, the reason why all of this is important is because often when news comes out, markets will go off in one direction, such as down here, and they will actually go below the wicks, below all of this into the cheap range or into another area, and then they will reverse from that area, and then all of a sudden it's like a bazooka, and it goes off in this opposite direction. Now, if you see that, and it takes these lows or these highs or these areas, and we'll give you a simple strategy today that you can start to put in your charts to think differently about news and just in generally market opens. This can be what they call, a trap. Because what happens down here, can anybody in the chat tell us when it goes underneath the cheap orders here, what would a lot of technical analysts, a lot of retail traders think? So we break through this level, it starts going off, news has come out here. Oh, the market's going short. Look at that, I'm getting involved. What would you have done if it breaks through this low? Tyron, what would you have done in the past?
If it breaks through the low, I would be looking at potentially selling even more.
That's exactly what you probably shouldn't be doing, but exactly that's what I would do as well when I first began. It'd be breaking through the low, and we'd be looking to sell more because guess what, guys? It's broken through. As we mentioned, the close is the key, and often you'll find it's really this is all being done on a much higher time frame. Remember, we assume that somebody else is looking at a 1 minute or a 30-second chart or a 5-minute chart or a 3-minute chart when we're day trading or scalping. Really, there's mostly algorithms on those timeframes trading much bigger concepts. And when we break through those levels, often the daily will completely reject and go off in the opposite direction. You'll be left scratching your head saying, what just happened? Well, that's actually the time that you should be reacting and jumping on board the new freight train, which is going the opposite direction. You know, the hardest part about all of that, Ty, it's not that it happens. It's actually for you to have the patience to wait for it to do this and not get involved in what looks like easy money. Because every so often, let's say a third of the news events that are big red news just go off and they never come back. And what does that give us? That gives us the illusion that that's going to happen every time, doesn't it?
Yep. And it's actually the opposite of what we certainly did when we first started. And like every other trader, we would see that break early on and think, okay, this is where the market's going. We've broken through, not realizing and not looking to the left, more importantly, that this is what is actually giving us a sign that this is a trap. Identifying the traps, I mean, it's probably just as important as actually locating the right entry points, isn't it? Really, like, I mean, we always talk about entry points, stop loss, and take profit as the mainstays of all good trading. But identifying traps can be certainly put in that category as well, because for every trap that you identify, now look, sometimes it's going to go anyway, right? Like sometimes it does actually break through and keep going, but for the most part, if you're sitting there and you're trading very consistently on a daily or weekly basis, if you can identify the traps, I would probably almost say that probably 8 out of 10 times you're going to save yourself a considerable amount of money, Thomas. And realistically, every trade that you save by not actually entering is one that you don't have to actually get back. And that's a golden rule that we actually abide by. Like, taking only quality entries is key to a lot of why we've been able to make a success out of trading, because the bad ones are the ones you don't want to have to be getting back, because they lead to all sorts of emotional trading, like revenge trading, doubling down, martingale. There's a word we haven't heard in a while. They all come out to play, and that's what you want to avoid. So identifying the trap, and when you think about it, it's not that hard to actually identify if you actually look for the candle structure prior to the attempted break.
Yeah. 1 second. Sorry, guys. That was a sound modulator. Don't worry about that. So look, absolutely, Tyron. It's all about being able to, really pick your things. I always say the difference between a successful trader or a pro and a non-pro is always the same thing. It comes back to one simple factor. You know when to stay out and you know when to get in. It's not predictive power. It's not that you could say to maybe Tyron and I are slightly better at predicting than some of you out there. Maybe we're worse. But what we are better at doing is waiting until we've seen something that we can replicate, and then we can replicate it again. And every single person, every single trader I've ever spoken to that is successful and trades hundreds of millions or tens of millions or even millions, they have always done a replication strategy. And if they don't get what they want, they're not doing it. No one can tell them any differently. And they're just sitting there waiting for the next opportunity. And that is a very huge trait. I'd say it all comes down to temperament. But anyway, this is really the psychology component. I know it's boring to some people. Let's see what the chat thinks about that. I think it's super exciting because this is the type of stuff that really changes the game. So, of course, as we said, during news, 1/3 of the time we were right. The market would keep going and it would go off in the direction and we'd think, how good is this? The problem is when we got involved in the news as well, Ty, where are we going to put our stop loss? Behind the high? Where are we going to put our take profit? It was a lot of guesswork.
Yeah.
And the problem with guesswork is we couldn't create replication because we couldn't get good ratios. So even when we were right, it felt really good, but you were really gambling in the markets. And I didn't really want to do that anymore. So instead, what we did was we found this patience ability to react. And once we have the trap set, where do we put the stop loss? Underneath the trap. We actually have a fixed area where we can say, okay, the stop loss is there. And often when the trap's set as well, if shorts come in here, when the market goes off the opposite direction, it squeezes those shorts. And unfortunately, your account, if you've sold, goes more and more and more negative until potentially you get margined or something else horrible happens. And the market just keeps squeezing. And sometimes you'll see these news results where they'll go one way, the opposite way, and the squeeze is real. So how do they enter into those markets? It's very important to consider that. Now, I want you to think about markets also from this price action sequence. And that is this one over here, which we'll look at in just a few moments, based on a daily close as well. And you can see that when news comes out, often markets will go to new highs or they'll go to new lows, and then they'll reverse. How do we know the reverse is real? Generally speaking, it will break through a first time frame change of trend. So usually time frame change of trend supply or demand. And this will be that last peak or that last trough. And once that occurs, you know the trap is set and you can pretty much say, okay, I've been patient and I'm ready to get in, whether that's on a like kind of comes back up, some type of fib, or whether it's just literally a short at that point with a stop above here. You've seen what you need to see. You've been patient. You're giving yourself the best odds in the market.
Yeah.
So I'm going to show how this looks, but Ty, you'd like to say, yep.
Yeah, I was going to say, look, one thing about being patient, I know I guess we probably sound like we're repetitive when even if we're not in a Darth Vader voice, when we're repeating what we're actually saying, but really, I'm sure a lot of you have been there when you actually get a trade, and even if you have traded the news on occasion and you've been able to take a really good win from it, but really all you've done is pick the direction right. And it might give you a gratifying feeling at the start. And you say, well, you know, this is awesome. You know, I reckon I've got this. But I think deep down, you've got that hollow feeling knowing that, you know what, that's not really replicable. You were probably a little bit lucky in the direction, because that's really all it is. If you got the direction right, and that's the truth. But when you've got something that you can actually rely on, where you can actually put a stop loss, you know, look, I'm not going to lie, when we first started, the first couple of news events that we traded worked out very, very well for us. But yeah, it could have gone very, very badly. And we knew at the time, didn't we, Tom, that this is not replicable. We were lucky, and it worked out for us. It could have easily gone the other way. And we were, I guess, we'll call it clever enough to say, you know what, we're not going to do that again, because all we would have done was given it back eventually, right? So getting a replicable system where you can identify a situation, just like we're talking about now, and be able to actually work around them, be able to put a stop loss in, put a take profit in, understand what the market should likely do, then, you know, when you do truly get a win, you can actually celebrate it properly, because you know that is replicable and you will be able to do it again, over and over again. That's a system, okay? That's the difference between that and having a guess as to which way the news should go in your mind, because that's not a replicable system.
All right, so we've got a question coming in from Jack, and he said, it would be nice if you could share some chart pattern analysis for these things. Don't worry, Jack, I've got you covered. That's why we're over here on the charts. So first up, I want to basically talk about daily and how important the daily level is. So of course, daily chart analysis is very important. We know that daily candles can hold the key. Now, a replication strategy that often happens around news and around opens is highs and lows. So here we have the previous high, here we have the previous low. Something happens up here. And I want to reiterate that this is very specific to certain opening times and also news that comes out around them. Now, you can pretty much guess, where does news generally arrive? Does it arrive just before the market open or just after the market open? Or does it happen all the way through the session near the end of the day? What do you guys think? Tell me, when you're talking about market news relevant to that market, does it happen in the morning, just before, or just after? Or does it happen later on? Let me know in the chat. Now, while we're doing that, I'm going to set a timing. So in TradingView, if you have your Pepperstone connected, or if you use MT4, MT5, you can select different timings, I guess. Basically, what you're interested in is something around Chicago time or New York time. So we'll use UTC -4, okay? And what I want to do is I want to understand straight away, where is most of the news when it comes out? For most currency traders, commodities, and indices, it's going to be London Open, pre-London Open to post-London Open, or it's going to be New York. Okay, generally they're the two times, and it's going to be before to slightly after. So around the open is where most big economic news comes out, and that's always important. When we now drive into a smaller time frame, what I'm interested in each day is the high and the low. It's that simple. That's actually one of the things I'm interested in, and I mark both of them on the charts. And then what we do, so I've marked it here with this red line. If you want a bit of a little tip, you can use hotkeys, which would be Alt-J or Command-J if you're using a Apple Mac, and we can go down to a 5-minute chart. Now, here we have the previous session high, and you can see actually it's very, very key, because look at this time frame. We've had over here on the left-hand side some very interesting period of time, because of course it went up to this high. Then it came up here, and then I would guess this is actually a news event of some kind, or at least the beginning of a market open where something's gone down, something's gone instantly back up, and then all of a sudden it's done something up at these highs. And this is the being patient and reacting kind of concept. We know that's the daily high. In fact, we could mark it. So one of the things I like to do if I don't have a color set for it is I could say day high. Okay. So once we are on the smaller time frame, we know what's happening here. Now, have a look at the time frame, 5 minutes, so very scalpable time frame, and have a look what happens here and look at the timing. So this is around 5 a.m. in the morning, and I like between 12 midnight, so that's about 12 a.m., to around 10:30 a.m. And this is for New York or Chicago time. It doesn't matter. It's very similar timings, obviously an hour apart. Now, why are we doing this? Because we know that most news appears here to here. Where does liquidity come in? Most liquidity comes in from here to here, then dies off during the mid-session, then comes back at the close, of course, when the 401ks and the big super funds and all these things actually inject into the market. So here's the day high. So the market comes up and it goes do, and you might think, well, that could be a good sell. I don't know that. I don't know anything. At this point, the market's gone down and up really huge, and it's gone back into this level of supply or resistance. Then the market's broken out past our day high. Now, this has happened between 12 a.m. and 10:30 a.m. Very important. Once it then turns and it comes down, after it breaks through this level here, which is effectively a high, a low, a higher high, and a lower low, we basically have the turn. And what this tells us is at that point, we know that this most likely is a trap and that the market has falsely gone past the day high to instigate buy orders that are now sitting up here, and it's time to squeeze them. And we need to squeeze them for the rest of the session at least, type. That's what we need to do. We push down and take all their money. And this is a very common thing that does occur. It's quite a good little basic strategy that tends to appear between those times. So you can see here that this is one of the biggest components to really understanding markets. It's to be patient enough to see a replication strategy that you can then say, okay, I know what's happening here. I know that in general, either this market's either going to go down, it's for the session, so maybe go down for the rest of the session overall, and by the end of the day, I'm going to close the position, or it's going to, go to a certain take profit, which could be down in these previous lows, but that's generally the type of system that you're looking for. High steals or low steals coming off that big liquidity position. So Tyrant, this is like one of those things that I think most people make big mistakes on. They get involved in this.
Yes.
Very hard to replicate that. What is
very
that?
Common. It's very, very common that people get involved in that initial, it's almost like a sugar rush. It's almost like a kid in a candy store sort of thing where they need to be involved and they need to be involved now. The market's going without me, so I must get involved. And then, of course, only to see the big reversal. And then I think what's even worse is, and I think we trade and train a lot of traders and have done for a lot of many years. And I think what really irritates people the most, and I think what really gets people actually agitated and revenge trading the most, is actually to be taken out in that move, only to eventually see the market actually go there in the long run. and of course, without them, because their stop losses have been hit or their accounts have been blown. And that's very, very unfortunate, but it's a trap. That's why we call it a trap. And yes, initially when you do first start trading, or if you're a little bit inexperienced, it can be very easy to get involved in that and be sucked into trading that. But really, patience is everything. And when you actually see the quality entry, you'll realize why. And this is just a perfect example. This is not one we've just plucked out of the sky. Like, this is quite recent. Realistically, we could find you 100 examples, on a weekly basis, really, of these playing out. And so it's not like when we say patience, it doesn't mean that you're going to be trading once a month, right? Like, it's not like we're saying, oh my God, you're not going to trade. You're going to be trading a lot more than you think. But patience comes into actually waiting for the actual trigger point. That's what it really comes down to. It's not like saying you don't want to be unrealistic. Patience doesn't mean unrealistic expectation of a market getting to a certain place that may or may not eventuate. That's not what we're talking about. We're talking about patience. We're talking about understanding the market and what's actually happening, and being, I guess, not really smart enough, but actually being, patience is the only word I can use. Patient enough for it to actually get into the position that it already was. And I think that's probably the key. You're waiting for the market to actually return to a place that it already was so you can get involved. Okay. Patience is not setting an expectation of a supply level that's not going to get reached, because if it did, it would be awesome, but it may or may not get there. That's not what we're talking about. There's a very, very big difference.
Yeah, so here's a classic one of news coming out, Ty, and this is of course a day high over here, and then we see this huge market increase, which is very, very large. I mean, you can tell that's news straight away. Why? Huge volume. So when we get that huge volume, what does it do? Well, it takes out the day high, and you can see again if we go over to the day high, that it's it's a huge, huge deal over here. The day high is stolen. This was the previous high over another session. You can see this day high is also taken. And again, the payoff here is not that it's taken the day high. That could continue at that point. I don't know. I'm not going to be able to do anything about it if it keeps going. I'm actually looking then for the replication of it turning around at that point. So if it does turn around, I'll say, that was what I thought it was. It is a trap. If it doesn't turn around and there is no, initial pickup that you want to get into, then you're not going to trade it. It's as simple as that one. So if we go back over here and we have a look, that's not the one, that's the previous one. So let's go back over to the history. You can see here that we don't actually know that this thing is ready until it breaks over here a little bit later on. Now we know the trap was set early, so you can see the timing. The timing is very, very early. So it happens around 8 a.m. So that's cool. It's within the time slot of 12 till 10, which is pretty good. And then we get the switch, which happens over here, which is where we make that lower low after we've made the high, low, higher, high, and then lower low. Now that's a huge turn. And of course, this is going to be one of the big things that we're looking for. So yeah, when that happens, it's realistically one of the biggest concepts, I guess, that you can use around news, around opens. It's a day high, basically steal, but it must be that you wait for the actual reaction of the market. If you don't have the reaction, you're basically trying to predict, you're trying to guess, and you don't have that replication that you should be using. So this is one of the strategies around news that you can use, which is day high or day low steals that happen around those particular points. The next version of it, though, Ty, would be to go a whole level more, which would then be able to understand, okay, where is your supply, where is your demand, and where the markets are pushing those extremes as well. So let's say we came into this particular day. So we come into this day on the pound. We could say, okay, well, we know we have a day high up here. From this current day, this is obviously the day low. We broke through the day low. So let's have a look at the day low when that happened. So day low was broken. It's probably broken over in this area, I guess, over here, which happens within the timing that you're talking about. But was there any news? Was there any movement back up? Well, at this stage, no. And if there is none, then there is no trap and there is no reason to be involved in it. But that's something that you're going to be looking at. You also need to think about, is it at a location that makes some type of sense? When we were at this one up here, which is a steal, we know this is a critical high. How can we tell that? Using higher time frames. So if we go to the higher time frames, have a look over here on the left-hand side, look at where that trap was set. Significant zone, isn't it, Tyrone? Very, very high time frame. It's a big, big deal.
Yep. And a lot of people will say,
how are you going?
Yeah, a lot of people would say, that's really obvious in hindsight, but it's actually not. And this is why you have to actually look at the different time frames and you have to actually label your lines, because if you do end up with too many lines on your chart, you can actually miss why that line is important. Sometimes it's not immediately evident on the chart at hand, but when you actually zoom right out, it's really, really important to label these lines, because that is a very, very significant zone. And not all resistance is the same. Resistance can be very, very different depending on why it's been formed, how long it's been formed, and the time frames that it's appearing. So I encourage people, and Thomas does the same. Label your lines until you really understand them, or even if you don't want to label them, color code them. If you know you've got weekly resistance or daily resistance or whatever it is it might be, label it a color that you understand. That's the reason why we use the same color moving average all the time. We don't have to think about which moving average is on our chart because we know the color. And it's as basic as that. You can do the same with support and resistance to really immediately identify, because here's the thing, right? If you actually miss that was actually very strong resistance on a weekly, you could actually fall into a trap without even knowing it, because you've missed a very, very good opportunity. Not only you've been caught out, but you've actually missed a really good opportunity to capitalize. Remember what Tom said earlier about what the big traders really do. They wait and they're patient, but when the trade's there, by golly, they're in, and they're in big. Because sometimes you have to be because those opportunities don't always come up. Like, you're not going to get weekly resistance tests every single day, right? Those things can be very, very long in setting up. So it's very, very important to spend a little bit of time, even if you're doing it on the weekends, opening up the bigger time frames, the bigger charts, that when the charts aren't moving and you're not looking for a scalp, and actually drawing your support and resistance at those times when the market's not moving, because you're focusing only on actually identifying really key levels at that point. Don't do that when the market's open, though, because you're going to get caught in the trap of, I think I should be placing a trade now, Tom.
Well, that's absolutely right. You need to do your analysis first. Play the chess games. Be ready for all of the different actions and the different areas. By the way, if you're enjoying this,
do it on a Sunday before the week starts.
Absolutely. Sunday is a great time. In fact, I do most of my chart analysis for the week around those periods. Obviously, we do a live show over on YouTube under FX Evolution. But the thing is that when we're doing those, I do all the weeklies. I do all my options, implied vols. I do all of my key kind of work that is going to be there, the pivots, everything, all the sector rotation, every single thing I can really think of is a clear mind before you have anything there. So that when the news is coming out is like this, you're ready.
No distractions.
Here's another opportunity that was only a few days ago. This is a day high that I marked out on the euro. This is actually one that I had in our private community tie, and it was one that I was talking about, that if we took that day high around these times, then it would most likely do a turn towards the sell-on side. So you can see that it doesn't activate until I've written that line in here. So this is where I had a very good reasoning. Possibly you could have had it here, but for me, it was here. And this was basically the area where I started getting interested in a short on the euro. Now, as you can imagine, if you actually held that short, you would be on fire right now. You'd be very, very happy with yourself. But generally speaking, you can't guarantee they're going to go massive distances. What you're doing is usually for the rest of the session into maybe the beginning of the session until we get back into London. So you can kind of, often what happens like into New York, into the close, often it pushes down into that area. Sometimes the daily continues on the next day into maybe London. And that's where you see that big liquidity come in to potentially reverse that trade. So a general rule of thumb, really simple concept would be, if you see these things happening during London or during New York, around you, stealing these highs, those types of things, then usually they go for the rest of the session once they have placed the trap, once you have reacted to that particular information. We've got some questions coming in here. It says, do you include pre/post when drawing lines / marking levels? Generally, I would only include the real market action. What you're talking about with pre-post is obviously stocks. So we're talking about futures market action. I 100% use futures indices, and I use all of the analysis there, but I use both. So, of course, with the stock market, we have to ask ourselves, where is the biggest amount of volume? I still think it's around 2/3 of the volume goes through during the market hours tie, but futures are becoming a real thing. So when it comes to seeing extreme highs or extreme lows, I'll generally use the futures market. When it comes to understanding, gap fills or anything like that, obviously we use the real market with the indices. And when it comes to including pre-post individual stocks, I generally speaking use the real market more than pre-post stocks, because they're more of a new thing, especially with the amount of time that we now can trade. I don't think I ever remember being able to trade so many hours after. How much was it when you got in tie? How many hours could you trade post?
Yeah, it's incredible now, actually, how, it's incredible how many hours you can actually trade. Yeah, even with options. I mean, they're even opening up the options market for hours and hours after the actual market open and close. So the opportunities are endless, really. I mean, look, we've always known that. And I think that with the advent of the new platforms and basically, I mean, with Pepperstone, you can basically trade almost anything at any time. I mean, you can literally just sit there and trade 24, 5.5, I think it is still. And I think if you're trading Bitcoin, you can trade 24/7. So, really, the opportunities are endless. But I think that really speaks to what we're trying to say here, that there is no need to be predictive in your nature in trading, because you can actually react and be patient to the trades they're actually setting up that are proper. Like you can do analysis on 20 different instruments in different time frames. You might only trade one or two of them. And one of them is going to give you the opportunity. So what we're probably trying to say is there is no need to be, I guess, reactive to what you think is going to happen, or you're thinking you're going to miss out on an opportunity, the FOMO effect, because there's so many different instruments that you can trade. There will be a setup somewhere. And these work, on almost anything. Like, you're going to get better results on highly liquid currencies. Correct. And indices, of course. Like that is a prerequisite. Like if you're going to go trade a penny stock, things like this aren't going to be as apparent, and they may not even work. I mean, it's because there's just not enough volume, right? Volume is key. You need to understand how much is actually going through, because if there isn't any, really big positions being placed in strategic levels, then this is just simply not going to set up. So you've got to be mindful of that. But at the same time, with so many different instruments available to you, why would you be trading something that's really illiquid and hard to get into and hard to get out of? It doesn't make sense.
Yeah, it's not really something that you would want to do. I think you do need to be very careful on instrument selection, Ty. And if I was to say what would I select, it would be USD majors, JPY majors, CHF majors, and maybe those kind of combos would be some of the ones in currencies. Obviously, gold is possible with this. I would not trade something like a copper with it though, or I wouldn't trade necessarily even a silver with a similar system. Indices, S&P 500, obviously one that is always worthwhile considering, but it does drop off pretty fast in indices. Sometimes the DAX, the ASX 200 can be used, but not always. And it really comes down to, the liquidity side of things. US 100, of course, and also US 2000, which has become a bit of a favorite of mine this year. And I know yours as well, Ty. So
I love
Russell.
I
Russell's been pretty good.
I start my analysis on the Russell every live stream on a Wednesday. It's my favorite. It's the go-to to start the session, because it tells us a lot about the other indices actually without even knowing it.
Yeah, I just was on the euro, and obviously I knew there was one over here, but I was just seeing this again, a news related one. You can see the initial news reaction is bullish, just proving again that the market's come up. Now, why has it come up? To grab liquidity. And you could make a lot of cases for this level, by the way. If you notice, I've got a big red line here, which a lot of you would see as a trend line. So see how things are kind of confirming across. You could say, well, market's broken down, market's come back, testing the trend line from the bottom, but it's also taken out that daily high at the same time. Then we've got the switch to the downside. We have been patient, we have reacted, and we can then look towards the market going in that direction. So it's a very simple idea, but often some of the best. I don't know if Dane's out there today, but Dane's been on a big journey in trading, and he's obviously gone through a lot of learning opportunities, and he's learned tons of things. But he often, has come back to the simple and the basics as well, and he's found that that's given him excellent replication. Yeah. So that's very important, isn't it, Ty?
No,
to come back to simple.
Most definitely. And look, you guys who have been with us for a while now, and a lot of you have, I know, we've got a very strong team behind us that follow these webinars very frequently. Have you noticed that we very rarely have, many different indicators on our charts? It's very rare that you're going to see a heap of indicators. We try to keep them as simple as possible, because you've got to be really, really careful that you identify the most important aspect of trading, and that's price action. That tells you all you need to know. The indicators are just that. They're an indication of what may or may not happen, but you don't want them to cloud your screen or your judgment. Price action will always be king. And if you really focus on that, you might be surprised at how much you can actually learn and interpret without all of the distractions that can sometimes be. I mean, I've seen, we've all seen them. We've done tutorials where people have brought up charts where you can't even see the price action. There's so many lines and squiggly bits and indicators on the screen. And I'm like, well, how do you even read this? Because you can't actually see what's the most important. And that's actually price. Oh, gosh. I'm nearly gone blind.
I love this chart very much. Don't worry. But that might be something that someone looks at and goes, what the hell is that? Yeah.
So, look, and it's really, really important to keep it simple. I mean, I know it's all right for us to say, like, we've been doing this for years now, and, and we're lucky enough to have been able to learn it the right way and actually build on our ideas. And yeah, a lot of people seem to think they need indicators. They need, they need stochastic crossovers to trade a channel. They're useful to give you confirmation, but they're not the reason you trade. And I think that's really a really important part of what we're trying to portray here, that you must pay attention to the price action and you must pay attention to levels. In our opinion, or in my opinion, certainly, I don't want to speak for Tom, but support and resistance are two of the most important features of any market that you're going to look at. Price action is extraordinarily important, but they're probably, support and resistance probably supersede most indicators because they're giving you so much information. And so many good traders that we know trade only off support and resistance alone. And so that's how powerful it can be. So never, ever underestimate it. And probably, very, very importantly, label it correctly. It's very, very important to understand that. When that becomes second nature, trading will be a very, very simplified process for you.
So I guess we'll go over to questions now, Ty, and we'll kind of just reiterate that news is about understanding that markets will push extreme points, whether it's support resistance and markets therefore go into, breaking a resistance or breaking a support after the news, or it's supply and demand and they go into a supply demand level, or take the high or take the low of the daily close or weekly close. These can be very good zones for you to actually think about the markets differently, to wait for a reaction in the opposite direction and therefore take advantage of that. You'll often find that markets will go opposite to the overall direction of the now existing prevailing trend as well. And that's to grab liquidity. So it can be an extra kind of little tell. If the market's in a short, the news comes out and it goes super bullish, and then it suddenly breaks through a high, then it reverses the way that you thought it would around that daily close or daily high level, then all of a sudden even stronger in favor of your particular trade. Now, the US session, London session, often considered the best. If you're going to trade the Asian session with Pepperstone, in general, you should be looking at more yen pairs, gold, odd, New Zealand, those types of things. Think about the market that you're trading, the time that you're trading as well, because that's when that liquidity comes in. So liquidity comes in with Wellington in New Zealand. Then we see Australia and Sydney. Then we see all the rest of Asia obviously open up. There is liquidity there. It's getting bigger all the time as we see those markets expand. But at this stage, it's still London, New York.
Yep.
And if I was to say which are the two best, I'd have to go London currencies and commodities and US indices.
Yeah,
for sure.
And I think this probably highlights, Tom, to everybody why we revere the daily time frame so much, because the daily candle encapsulates all of these time frames, like all of these major indices, all of these major sessions. Get to have a say in where that direction is for the day. And that's why the high and the low of the daily candle is so important to respect, because every single world market has had a chance to pull it one way or the other. And that's why that information is so vital.
Now, we've covered this one before, but I was just going to show people volume profile for obviously sessions. So if we go here, session volume profile, and we check it on. This can be quite handy if you're somebody that's interested in understanding if the market's coming back to a previous session's basically fair value. Now, what the volume profile shows you is it shows you that trading period, and it will show you the most traded zone with the little red bar here, which will be the point of control. Now, we've covered volume profile before, but I just thought I'd show you that often markets will, if they're let's say in this case here where we see the day high stolen, you can see the market has actually come back up to the previous, or to what has become the biggest trading session. In the previous one, it was obviously here. And we know that there's a ton of trade through here. So the market's gone low, the market's come back up. And then if you were shorting from this zone, you may have wanted to target in this volume profile. It can be very, very handy for that type of thing. But yeah, I'm always interested, where is the most amount of volume? Where is the previous day's trade? And notice that even though there's tons of market action here, or what looks like it, you can kind of see why it would come back to this level. Most traded level the previous day, most traded level this day, most traded level the next day, very close to being the most traded level again. So again, great take profit area. And then of course now we're potentially switching. But even right now at the time of the live, the most traded level is sitting there from the previous session. So these can be handy little tools. It's using volume. Obviously, Tyron and I are a fan of that as one of the indicators. But yeah, Torphy says here, stop using indicators after doing the course. Yeah, and Torphy's doing very, very well. You got a 25-1 the other day. Congrats to him on that. That's not a bad ratio. Some people would dream of those types of ratios. So, yeah, that's always good to see. All right.
Very, very
well,
nice
I think, Tyrone, this brings us to the end. So today we've covered all those topics. Obviously, we'd always like to say a big thank you to everybody out there. If you enjoyed today's topic, then make sure you smash the thumbs up and leave a comment as well if you want down below. I have been reading a few of them. Very nice. Thank you for the kind words. And if you enjoyed, something here and you learn from it, then that's even better. It's always great to impart knowledge and to show you guys some of the ways that we think about markets. So remember, the next time you see news, it's always going to be a question of, are you going to trade the direction you think it's going to go in? Are you going to go and trade the direction that it's going in initially? Or are you going to wait for the trap and potential liquidity steal? I know which one I would pick, Ty, but of course, for other people, it may be something else. Hopefully, we may have maybe put an imprint on your mind. I'll catch you for now.
Thanks so much, everybody. Thanks for giving us your time tonight. And thank you, Pepperstone, for putting this on. We look forward to seeing you at the next webinar in 2 weeks' time. Have a great night.
See you, everyone. Bye for now.